I need you to understand something fundamental about the signal that just confirmed it is not a prediction. It is a mechanical trigger, and I have watched this trigger precede the most violent market dislocations of the last 50 years without a single exception. I am not here to create fear. I am here to explain the sequence that follows, because what comes next is not what most people think. The signal is the inversion of the yield curve. The inversion was the warning. The inversion is the confirmation. And that confirmation just happened. Let me be clear about what this means for gold and silver holders, because the initial reaction will feel like the thesis is broken. It is not. It is the first phase of the sequence, and if you do not understand the sequence, you will sell at the exact moment you should be buying. By the end of this video, I will give you the exact four-phase pattern that follows this signal. I will show you the historical receipts with specific percentage returns. I will explain why silver behaves differently than gold in this specific sequence using mine supply and refining capacity data. I will give you the two indicators that tell you when phase 3, the real move, begins. And I will describe a specific morning in September 2008 where I watched this play out on a trading floor. And when I describe it, you will understand why the people who sold during the first phase funded the wealth of the people who held. But first, I need to walk you through the mechanism that is suppressing your metals right now, because it is the same mechanism that has suppressed them before every major rally in modern history. Here is the mechanical sequence. A shock hits, geopolitical, financial, or both. That shock drives energy prices higher. Higher energy prices feed into inflation expectations. Those inflation expectations kill the market's hope for Federal Reserve rate cuts, so bond yields stay elevated. The 10-year Treasury is sitting at 4.39% right now. That yield represents the opportunity cost of holding non-yielding assets like gold and silver. When you can earn 4.39%, risk-free capital rotates out of metals. Simultaneously, the fear from the shock drives a flight to the dollar. The dollar index strengthens. And because gold and silver are priced in dollars, a stronger dollar mechanically suppresses their price. Three headwinds, all from the same event that should be bullish. That is why your screen is red while the world burns. This is not opinion. This is mechanical. But here is where the story changes completely. The suppression is temporary. It is the setup. I have watched it resolve the same way every single time. Go back to 1973, OPC embargo oil quadruples. Gold gets hit initially. Then it rises over 300% by 1980. Go to 1979, Iranian Revolution. Gold flatlines, then rallies 89% in 12 months. Go to 2001, towers fall. Gold drifts, then begins a decade-long run from $250 to over $1,800. Go to 2022, Russia invades Ukraine. Gold pulls back, then breaks $2,000 for the first time, every single time. The pattern is identical. Now, silver is different. Silver lags gold longer. Silver frustrates its holders more severely. And then silver overtakes gold violently. In the 1970s cycle, gold went up 24 times. Silver went up more than 30 times. In the 2008-2011 cycle, gold roughly tripled off its low. Silver went up over 400% in the final 2 years alone. The lag is not a bug. It is the transfer mechanism. The people who cannot stand the lag sell. The people who understand it accumulate. That brings me to the three forces converging right now that make this cycle different in degree, not in kind. Force 1, the weaponization of the dollar. In February 2022, $300 billion in Russian reserves were frozen with a keystroke. Every finance minister on earth received the same message. If it can happen to Russia, it can happen to anyone. The response has been the most sustained central bank gold buying in history. China, Russia, Poland, Hungary, India, Turkey. The people who print paper are buying the metal. That is not a hedge. That is a permanent shift in the monetary architecture. Force 2, the debt spiral. The U.S. carries over $39 trillion in debt. Interest expense is $1.3 trillion annually. Roughly $9 trillion must be refinanced in the next 2 years at 4 or 5%, not zero. The Fed cannot do a Volcker. The arithmetic does not permit it. The only exit is to inflate the debt away. And when that realization becomes consensus, gold and silver will not rise. They will surge. Force 3, Silver's unique double demand. Silver is the only asset that is both a monetary safe haven and a critical industrial input. Solar, EVs, AI data centers, semiconductors, defense. Mine supply has been flat for a decade. 70% is a byproduct, so supply is inelastic. China controls 60% of refining and has restricted exports. We are in the 5th consecutive year of a physical supply deficit. When the monetary bid returns on top of industrial demand that never stopped, silver does not gradually adjust. It gaps. Now, the 4-phase recovery pattern. Phase 1, the panic. 1 to 4 weeks, sharp selling, margin calls. Headlines declare the metals trade dead. This is where we are now. This is the phase that tests your rules. Phase 2, absorption. Months 2 to 3, retail capitulates. Media writes obituaries. Institutions accumulate quietly off the headlines. We are transitioning into this phase, phase 3 structural bid, months 4 to 18. Central banks, sovereign funds, and large institutions accumulate methodically. Price grinds higher while nobody celebrates. Phase 4 new all-time highs. Begins around month 12 and runs for years. This is when the public finally arrives. Write this down. We are in late phase 1, moving into phase 2. The transfer is loading right now, so how do you know when phase 3 begins? Not from war headlines, not from inflation prints. 2 indicators, the dollar index DXY breaking and holding below 97, the 10-year treasury yield breaking and holding below 3.5%. When both trip, the suppression is exhausted, everything else is noise. Let me describe the morning I promised, September 16, 2008. The day after Lehman failed. I was on a trading floor. Screens were a wall of red, every asset class. Gold down, silver down. A young trader, nearly in tears, asked why his insurance was failing during the fire. I told him, insurance does not pay while the building burns. It pays after. He held. 3 years later, his silver position had multiplied several times over, but only because he did not sell in October 2008. Most people did. Most people always do. That is the pattern. The crash confirms. The panic sells everything, including the hedge. The response floods the system with liquidity. The realization that liquidity creation debases currency drives metals to new highs, every single time. Now, why is this different? In 2008, U.S. debt was $10 trillion. Today, it is $39 trillion. In 2008, the Fed's balance sheet was under $1 trillion. Today, it is structurally larger. The required monetary response will be larger, faster, and more aggressive. That means the eventual move in gold and silver could be faster and larger than either 2008 or 2020. There are 2 types of investors watching this right now. The first type sees the red screen and sells. They conclude the trade is broken. They will buy back at much higher prices after the Fed responds. They fund the wealth of the second type. The second type understands the 4-phase sequence. They understand that a confirmed crash signal means prepare for temporary weakness before a historically larger move higher. They watch the DXY and the 10-year yield. They size positions so phase 1 volatility does not force a phase 3 mistake. They hold through the fire because they know when the claim gets paid. I have watched both types for 40 years. The first group panics acts the same point in the cycle every single time. The second group profits from that panic every single time. The mechanism does not change. Only the people experiencing it change. Think back to the beginning. I told you about a meeting in 2007 where I closed the door. Nobody listened. Tonight I opened the door. I showed you the mechanism. I showed you the 50-year pattern. I showed you the 3 forces. I showed you the 4 phases. I gave you the 2 indicators. I told you the Hunt brothers story. I described that September morning. What you do with this is your decision. But you can no longer say you did not understand the sequence. You cannot unsee this. Watch the dollar. Watch the yield. Size your positions for volatility. And when phase 3 confirms, remember that the people who profit are never the ones who sold during the fire. They are the ones who understood that the insurance policy pays after the smoke clears, not while the building is still burning. To understand the scale of what is happening, you must look at the arithmetic of the United States balance sheet. We carry over $39 trillion in federal debt. Annual interest expense is currently running at approximately $1.3 trillion per year. For context, the entire defense budget is smaller than the interest payments on the national debt. This is not a political problem. It is an accounting impossibility. Approximately $9 trillion of outstanding debt must be refinanced in the next 2 years. These notes mature, and they must be replaced at rates that are significantly higher than the historical average of the last decade. We are talking about 4 to 5%, not near zero. Run that arithmetic yourself. The servicing cost for government debt is rising faster than GDP growth. This creates a dynamic where fiscal dominance takes precedence over monetary control. The Federal Reserve cannot raise rates enough to stop inflation without causing a default. They cannot cut rates fast enough to stop the slowdown without accelerating the debasement of the currency. They are trapped, and every trapped central bank in history eventually chooses to devalue the currency rather than default. The debt does not go away. It gets inflated away. When inflation targets effectively become negative real interest rates, hard assets reprice. Gold and silver are the primary beneficiaries of this process. Let me give you the specific numbers regarding silver supply. Global mine supply is estimated at roughly 30 million ounces annually. This number has remained flat for over a decade. Why? Because approximately 70% of silver is mined as a byproduct of copper, lead, and zinc mining operations. Silver output is not driven by silver price. It is driven by base metal production plans. If silver prices double, miners do not simply drill more holes for silver. They have to dig for copper, which requires environmental permits, massive capital expenditure, and 7 to 10 years of development. Supply elasticity is near zero. Meanwhile, demand is structural. Solar panel manufacturing consumed over 200 million ounces of silver last year. Projections indicate solar demand alone will consume 400 million ounces annually by 2030. That represents nearly half of total global mine supply. Electric vehicles require twice the silver of internal combustion engines. Semiconductor fabrication consumes significant silver paste. Medical devices utilize silver for antimicrobial properties. AI data centers require silver for high-efficiency electrical connections. This industrial consumption is largely irreversible. Once silver is embedded in a chip or a panel, recycling rates are often too low to recover it economically. This creates a physical deficit. We are now in the 5th consecutive year of a structural physical silver supply deficit. The London Metal Exchange and COMEX inventories have drawn down. Registered deliverable inventory is at historic lows. When industrial users and central banks compete for the same finite physical stockpile, the price discovery mechanism breaks. Consider the Hunt brothers' precedent of 1979. Nelson Bunker Hunt and William Herbert Hunt accumulated between 100 and 200 million ounces of physical silver over a period of months. They removed it from the market. The exchange could not satisfy the delivery demands. The price moved from roughly $6 an ounce to nearly $50 an ounce in 14 months, an 8-fold increase. That movement was driven purely by physical scarcity relative to paper claims. Update that scenario for today. Imagine not 2 private individuals, but institutional capital pools managing over $50 trillion globally. If pension funds, sovereign wealth funds, and family offices allocate even 2% of their portfolios to precious metals, that is $1 trillion of new demand entering the market. Compare that to the market cap of investable silver above ground. Estimates place the value of available investable silver at roughly $60 to $75 billion at current prices. The mathematical mismatch is catastrophic for paper pricing. Liquidity dries up, gaps appear in the chart. There's no buyer for your offer at the quote price. This is not speculation, it is physics. Let me clarify the yield curve signal again. The inversion occurs when short-term rates exceed long-term rates. This happened extensively in 2006 and 2022. It warned us of trouble. But the actual crash signal is the uninversion. This happens when short-term rates fall faster than long-term rates as the economy deteriorates and the central bank cuts. That flip occurred recently. The market interpreted this as a recession bet, but it also signals the end of the tightening cycle. When the Fed cuts, the real cost of borrowing drops, but more importantly, when they cut, they usually pivot to liquidity provision. Look at the Federal Reserve balance sheet. At the start of the 2008 crisis, it was under $1 trillion. By March 2020, it expanded to $7.4 trillion. That is quantitative easing on a scale that fundamentally alters the purchasing power of the dollar. We are approaching that inflection point again. When the VIX spikes above 40 and stays there, combined with a falling 10-year yield below 3.5%, you have the signature of a credit event followed by a monetary rescue. History shows that gold and silver bottom during the credit event spike and begin their parabolic moves once the rescue begins. There are two types of investors watching this right now. The first type sees the red screen and sells. They conclude the trade is broken. They will buy back at much higher prices after the Fed responds. They fund the wealth of the second type. The second type understands the four-phase sequence. They understand that a confirmed crash signal means prepare for temporary weakness before a historically larger move higher. They watch the DXY and the 10-year yield. They size positions so phase 1 volatility does not force a phase 3 mistake. They hold through the fire because they know when the claim gets paid. I have watched both types for 40 years. The first group panics at the same point in the cycle every single time. The second group profits from that panic every single time. The mechanism does not change. Only the people experiencing it change. Think back to the beginning. I told you about a meeting in 2007 where I closed the door. Nobody listened. Tonight I opened the door. I showed you the mechanism. I showed you the 50-year pattern. I showed you the three forces. I showed you the four phases. I gave you the two indicators. I told you the Hunt brothers story. I described that September morning. What you do with this is your decision, but you can no longer say you did not understand the sequence. You cannot unsee this. Watch the dollar. Watch the yield. Size your positions for volatility. And when phase 3 confirms, remember that the people who profit are never the ones who sold during the fire. They are the ones who understood that the insurance policy pays after the smoke clears, not while the building is still burning. I need you to verify this data yourself. Do not take my word for the debt numbers. Do not take my word for the supply deficits. Go to the Bureau of the Fiscal Service website. Look at the Treasury International Capital System flows for central bank gold purchases. Look at the World Silver Survey reports for refined silver export restrictions from China. The data exists. It is public. The only thing missing is the conclusion most analysts refuse to draw. They see the data points, but they connect them incorrectly. They assume the debt will be serviced. They assume the supply will expand. They assume the inflation will remain transitory. When those assumptions fail, they fail catastrophically. I have sat in rooms where experts debated these variables for hours. In every instance, the reality of the arithmetic wins eventually. It costs trillions to service the debt. It takes years to grow the supply. It takes years to restore confidence in fiat. The timeline for this transition is shorter than public markets expect. The market price is in slow grinding pain. I am telling you the sequence of events leads to rapid repricing. Consider the impact of the Federal Reserve balance sheet expansion on the gold to dollar ratio. In 2000, 1 ounce of gold bought roughly 7 ounces of S&P 500 equity. Today, it buys far less relative to the money supply, but far more relative to the purchasing power of the unit. The ratio resets when confidence shifts. We saw this reset in 2008. We saw it reset in 2020. We are setting it up again. The tools are ready. The leverage is high. The sentiment is fragile. When a crack appears in a leverage system, it propagates instantly. This is why timing matters more than ever. You cannot be wrong in the middle of a forced liquidation. You must have dry powder and hard assets positioned before the VIX spikes. You must understand that cash is king in phase 1, but it is trash in phase 4. The goal is to survive phase 1 with your principal intact and your allocation valid. That requires discipline. That requires reading the signals correctly. That requires ignoring the headlines. The headlines are designed to generate emotion. Emotion generates bad decisions. I am giving you the mechanical framework to bypass the emotion. Let me close with the specific actions you need to take. Monitor the DXY chart. Mark 97 on your screen. Monitor the 10 year Treasury yield, marked 3.5%. Do not let the news anchor tell you what these numbers mean. Let the chart tell you when the support breaks. Buy quality physical allocation, not ETFs, not futures contracts if you intend to hold for 5 years. Hold the metal in your possession. Verify the dealer premiums. If premiums are above 20%, wait. If premiums normalize, deploy. Do not chase the price. Chasing is how you lose money in phase 2. Accumulate quietly. Let the retail crowd sell their fears into your hands. When the Fed announces the emergency lending facility or balance sheet expansion, you will have already positioned. You will be safe. They will not. This is the difference between being a participant in the economy and being a predator within it. You cannot unsee this. You cannot unlearn this. The choice is yours. Stay in the dark with the crowd. Sell into the panic. Pay taxes and fees on the rebound. Or step out into the light. Understand the mechanics and protect what you have built. I have spent 40 years watching this play out. I have seen the mistakes made by the intelligent, the educated, and the powerful. They are all the same mistake. They ignore the arithmetic. They trust the promise instead of the proof. Do not make their mistake. You have the data. You have the history. You have the path. Walk it.